Hi, Anna and Madeline. This is a new proposal on the SAMA video. I've entitled it the new retirement package, and this is the point that I want to demonstrate. Please, this is very much a very rough draft, just to show you what I'm thinking. So there has been much media attention given to the new retirement planning arena that will become effective from 1 March 2016. The changes are fundamental to how South Africans approach financial planning, but they are also complex and require specialist advice. Let's have a look at what all the fuss is about. So for the last many years, we've been saying to our clients, you're born, you graduate, you work, and you retire, and then something else happens. What we've been saying is, when you start working, concentrate on your spouse and kids and buy a property. Then you start investing, and when you get to about 40 or so, we start talking about retirement planning. The important emphasis is that retirement planning only started at 40 and continued until you retired and then you received an annuity. This is now completely changed. The new tax regime on retirement funds that comes into effect on 1 March 2016 now lumps all contributions together, and the taxpayer is entitled to deduct 27.5% of taxable income. That's the good news. The bad news is that the contribution is limited to 350,000 Rand per year. Many wealthier taxpayers used to contribute far more than this in the later years that they worked. So retirement planning was really concentrated in the ages 50 to 65. That's no longer the case because of capping. So it changes like this. We're still born, graduate, and retire, but then what we are saying is retirement planning has to start from an earlier age to spread the contributions across a lifetime. And when people are saving and investing, they should also be considering supplementary retirement planning to maximize the tax deduction. And then we carry on making contributions until we retire. But even on retirement, it is changing. We are now looking at the tax efficiency coming from the management of retirement funds after retirement as well as before retirement. And this is a very integral point in financial planning. So retirement planning now continues until you die. There are other changes. Contributions and withdrawal from retirement funds is no longer linked to your actual retirement. Thus, a taxpayer is allowed to elect the date of retirement from each fund. So the correct way to deal with this is that one has a suite of retirement annuities. You may be contributing to some while you may be withdrawing from others. And that will continue until the day that you die. Why is this the case? Because retirement funds have huge tax advantages if they are correctly used. Let's summarize them. So, we have contributions into the fund that achieve a deduction of up to 41%. The important issue thereafter is that all income of retirement funds is completely tax exempt. And then there are other carrots such as a CGT exemption, and finally the death benefit of paid from retirement funds is completely estate duty free, even if it is paid in a cash lump sum. So now, when we go back to the way we used to do things, we had the retirement fund lump sum table, which used to give huge tax advantages. So everybody said you take the maximum amount possible out of a retirement fund on the day that you retire. That's up to 1/3 of the capital. But this doesn't make sense today once you go beyond 700,000 Rand. Because what people are doing is that they are withdrawing the total benefit and paying tax of up to 36%. So why draw down a capital amount? Pay tax on it. Then you're going to pay tax on the income it generates thereafter. And then you're going to make a fundamental problem in your retirement plan, you're going to tell your family that you've got money and everybody will want to have a loan. It's far better to say, keep the money within the retirement fund and only withdraw it when it's needed. Then you come to the whole question of tax management in South Africa, because obviously annual withdrawals from retirement funds are fully taxable. And we have to balance this. What we are seeing from the 2016-17 budget is that there is a decent tax deal for the bottom end of the tax scale. They get an annual fiscal drag adjustment, no tax increase. But once taxable income exceeds 550,000 Rand per year, the tax rates get very worrying. This is a mistake people make when they overdraw on retirement annuities. They do not realize that they are sharing their pension with SARS. So the components of taxable income in a modern retirement plan say we concentrate on working down the share portfolios, unit trusts, and insurance policies first, because the tax paid on the drawdown of those investments is much lower than the retirement fund. So we postpone the tax on the retirement fund until a later time. And then we need to optimize the deductions that one enjoys in retirement. These can be annual allowances, they can be geriatric rebates, and very importantly, they can be the medical rebate. And we put this all together in a principle that works on make tax deductions across a lifetime fund your retirement. Then we draw down on the living annuity and we neutralize the tax through the payment of the medical rebate system, neutralizing income against the lower tax brackets and drawing down lump sum benefits to the extent that they are available. So the conclusion is this, that in many ways the retirement annuity has replaced the trust as the optimum financial planning vehicle today. But to get this right takes a lifetime of strategy. This involves investment strategy, tax planning of both the contributions and withdrawal benefits, and finally optimizing estate planning benefits that can be achieved through drawing down retirement lump sums. It takes a lot to understand this, and a lot of people are well advised to use a competent professional advisor to achieve their goals. Okay, have a look at that and see how we can mash it around, see if you like it or not, and we can discuss it on Friday. Thanks very much.